The stock market is not the economy. Let me explain. Because companies that make up the stock market accounts for trillions of investment dollars, employ millions of people, and gather a lot of headlines, it's easy to believe that the stock market and the economy are essentially the same. When the stock market is up, you may think the economy is doing better. Similarly, when the stock market is down, you may believe that the overall economy is doing worse. The four key differences between the two are: first of all, the time period. Note that the economic measures related to the past can lead up closely to the present. Meanwhile, the stock market is thought to be forward-looking as much as 6 to 12 months ahead. The size is the second difference. While the US economy size is over $21 trillion, the stock market, here we're looking at the S&P as a proxy, is at present worth approximately $40 trillion, so nearly twice as big. The third difference is the way how they are measured. The two entities belong to entirely different categories. The stock market is measured at a specific point in time. The economy, on the other hand, is measured during a particular interval of time. And finally, the growth versus return is the fourth difference. It's also important to remember that GDP growth does not necessarily correspond to positive stock market returns. While the two can go together directionally, there are instances when the two have diverged. In some years, the stock market has gone up when GDP growth was negative. Example, 2020 and 2009. While in other years, the stock market has gone down while the GDP growth was positive. Example, 2000 and 2011. In fact, there may be little correlation between the GDP growth and the stock market. Why is it important not to confuse the two? Consider a scenario where the S&P 500 companies gain market share from the smaller companies that are not in the index. In that scenario, the S&P 500 companies could perform better than the overall economy. The economy and the stock market at times can decouple. While the economy is doing poorly in a recession, for example, stock markets can sometimes rebound. How can this be? It's important to grasp that the stock market is forward-looking. In the view of some investors, the stock market actually serves as a leading indicator for the economy. That means the stock market anticipates improving conditions, sometimes months ahead of when conditions actually start improving. And in times when the economy is performing well, the stock market can convincingly underperform. That's because the market anticipates problems and a slowdown in growth.